Okay, welcome to our Rural Business Briefing webinar. So great to see so many of you on this call today, especially when the weather is so good outside. We ran these events in person in October of last year and followed up with a webinar after that, and we had a great response. And so because a few things have moved on since we had that webinar, we thought it was worth refreshing the topics and running it again. Nothing stands still in the rural sector, and we've tried to pick topics that reflect areas of activity or concern for our clients, or areas that we think are worth bringing to your attention. We've picked out utilities because dealing with utilities is becoming an ever-increasing part of land management and land ownership, particularly with the grid upgrade projects under development. We will look at natural capital and recent developments in that market and where that might be heading. Business continuity and sustainability is also a key theme in the rural sector, and we'll look at how you can use matrimonial and cohabitation agreements to protect your business. And then last but not least, we'll bring you up to date on recent inheritance tax proposals and the latest consultation, which is currently running, and the opportunities that may present. So I'm joined here this afternoon by Scott Logan, who is a partner in our utilities team, in our real estate team. Also Gary Webster, partner in our rural business and natural capital team based in Inverness, and Mark Stewart and Sarah Lilly, who are both partners in our personal and family team to talk about matrimonial and succession and tax. So to kick us off, Scott is going to discuss utilities. He will then be followed by Gary on natural capital. Sarah will provide a session on the matrimonial side before we finish with Mark on tax and succession. Okay, thanks. Next slide, and I'll hand over to Scott.
Okay, thank you, Clive, and good afternoon, everyone. As Clive mentioned, I'm in the real estate team at Brodie's, and I specialise in compulsory purchase and utilities matters, hence me covering utilities today. The various utility providers, be it electricity, gas, water, telecoms, have wide-ranging statutory powers enabling them to compulsorily acquire rights to place their equipment on land. The exercise of compulsory powers for these purposes is generally recognised as being in the public interest, given the need for the utilities in question. But nonetheless, affected parties can feel that their rights are easily overlooked in the process and that compensation can be inadequate. Compulsory powers can be found in a range of statutes applicable to the different regimes, and I've listed a few of the more common ones that we come across in the slides there. It's interesting to note that each has its own rules and procedures, and it's difficult to understand why some regimes are more favourable to affected parties than others, but undoubtedly that is the case. Now, given the multi-million-pound investment plan for the electricity networks in Scotland to meet the ambitious targets for renewable energy generation as part of our transition to net zero, this afternoon, I'm going to focus on electricity and the powers available to licence holders under the Electricity Act 1989. These powers are wide-ranging, giving the electricity companies a number of options when it comes to acquiring rights and land. Now, if we could just move on. So Schedule 3, first of all, of the Electricity Act gives powers to licence holders to compulsorily acquire land and also rights in land. Licence holders can use these compulsory purchase powers for any purpose connected with the carrying out of the activities which they're licensed to carry on. So, for example, this power might be used to acquire land required for the construction of a new electricity substation, or alternatively for acquiring a servitude right of access to get to and from such a substation. We then have Schedule 4 of the Electricity Act giving other statutory powers to licence holders, including the power to acquire necessary wayleaves, a term that many of you will be familiar with, I'm sure. This statutory form of wayleave permits the installation and retention of electric lines and ancillary apparatus, so it is specific to electric lines rather than things like substations and the like. The key distinction between a necessary or compulsory way leave and a negotiated or voluntary way leave is that a necessary way leave runs with the land and binds successors in title for the period specified in the way leave, and that will usually be a 40 or 50-year period. In contrast, a voluntary or a contractual way leave will normally fall on change of ownership. In most cases, the electricity company will attempt to negotiate a voluntary acquisition in the first place. And as those discussions will take place under the shadow of compulsory purchase powers, most negotiations end up with a deal being struck, even if that is somewhat reluctantly on the part of the owner or occupier. Clearly, for landowners to be able to assess the strength or otherwise of their position, they need to understand the extent of the company's powers and the likelihood of compulsory purchase being sanctioned at the end of the day. So we'll now move on to look at necessary way leave procedures. So looking at installation of new infrastructure in the first instance, a licence holder may formally request the grant of a way leave from the owner or occupier of the land, allowing them to install and keep their equipment on, under, or over the land in question. If the owner or occupier fails to give the necessary way leave within the period specified in the notice, now that's usually kept to the minimum 21-day period specified in the legislation, then the licence holder may then make an application to the Scottish Ministers for the grant of a necessary way leave. Similarly, in relation to existing infrastructure, where a previous way leave has expired or has otherwise been terminated, licence holders have a period of 3 months following receipt of any notice to remove from the land to apply for a necessary way leave, or indeed to make a compulsory purchase order to keep the electric line in place. And provided they do that within that 3-month period, the line then has statutory protection and can remain in place until the necessary way leave application, or CPO as the case may be, is finally determined. Before granting a necessary way leave, the Scottish Ministers will afford the owner and any occupier the opportunity to be heard. This may take the form of a public inquiry or hearing in front of the appointed reporter, on whose recommendations the Ministers then take the final decision. Way leave hearings largely focus on site-specific matters. So a way leave hearing is not an opportunity to challenge the need for the related scheme or the choice of overall route. Rather, the hearing should be concerned with issues relating to the land in question. So it very much is focused on the impact on that particular land holding. So the reporter will generally look at two issues when coming to its recommendation. Firstly, is it necessary or expedient for the electric line to cross the land along the way leave application route in order to meet a specific electricity supply need? And that's really a kind of public interest test. And then secondly, what effect will the line have on the use and enjoyment of the land in question? And that second question gives rise to a balancing exercise between the public interest on one hand and the impact on private property rights on the other, ensuring that the process is human rights compliant. Now, it must be recognised that the odds are very much stacked against owners in this process, and that the prospects of successfully resisting an application against the necessary way leave or indeed CPO are not generally high. It would generally be expected that the licence holder will be able to establish the first part of the test, the kind of public interest part, to the reporter's satisfaction, and thereafter it will take something fairly significant by way of adverse impact to swing matters back in favour of the owner, particularly given the availability of compensation. So moving on to compensation. Where a way leave or servitude is entered into voluntarily, any compensation or consideration due will be governed by the terms of that agreement. It will be purely a matter of contract. In the case of a necessary way leave, entitlement to compensation is governed by paragraph 7 of Schedule 4 of the Act. So where a necessary way leave is granted, the owner or occupier may recover from the licence holder compensation in respect of the grant. And compensation is also available for damage and disturbance arising from the exercise of the rights. Now, the phrase compensation in respect of the grant, not particularly helpful, but case law has indicated that the general compulsory purchase principle of financial equivalence will apply in these cases, and also that injurious affection may be claimed. Here, the injurious affection may arise in two ways. Firstly, it may apply, generally will apply to the strip of land over which the rights have been granted. So whether that's over headlines or underground cables, the corridor through which the cables or lines run will effectively be sterilised due to the restrictions and what can be done within that corridor. So obviously compensation for the depreciation in land value will be due as a result of that. But injurious affection can also be payable in relation to any reduction in value to the wider land holding. And the typical scenario might be there where there are development opportunities on the wider land holding that might be lost due to the development, or the impact on residential properties in close proximity to the lines. Obviously, that will have a devaluing effect. Injurious affection is generally calculated on a before and after basis. So in other words, in order to calculate the depreciation in value due to the presence of the lines in the scheme, the land value at the relevant valuation date with the scheme in place must be assessed and then compared with the land value at the same date without the scheme in place. So if we could just move on again, please. In cases where compulsory powers are used, landowners should always carefully consider whether or not an objection should be made or other representations made. It's true to say that it is seldom the case that opposition will result in a CPO or an application for a necessary way leave being refused, and considerable expense will be incurred maintaining an objection all the way through the process. There may, however, be very good tactical reasons for making an objection, whether that's to secure a minor but important route alteration, mitigations, or other benefits, for example, accommodation works. In each case, it will depend upon the particular circumstances and a weighing up of the potential gains against the costs and the risks involved. As for negotiating more favourable terms in any consensual or contractual arrangement, and indeed it has to be recognised that most matters do proceed on a consensual basis at the end of the day, there are a number of areas in particular where adverse impacts can be minimised or mitigated against. Perhaps the most important here is agreeing the location of the apparatus and the extent of any way leave corridor. It's important to clearly identify the agreed route on the relevant way leave or servitude plan and ensure that within the documentation the rights are limited so far as possible to that defined route. As compensation is generally based on this, provision should be made for additional compensation to be paid in the event that contractors cause damage out with agreed working areas, or in the event that the construction period is extended beyond that originally contemplated. And that is often the case, that construction periods go longer than as expected at the outset. The duration of any agreement should also be considered. The electricity companies will typically insist on a perpetual servitude if injurious affection compensation has been paid out. And in most cases, landowners will be willing to grant a servitude given the more or less permanent nature of the infrastructure and the statutory protection it has. However, it's certainly not a case of one size fits all, and there may be good reasons to opt for a way leave that can be terminated on notice if, for example, a landowner wishes to preserve the ability to claim for loss of development value in the future. So, for example, if a landowner has development proposals, but they're not sufficiently advanced at the time a servitude is being granted or a way leave being granted. Time of works may be an important factor, and it may be possible to time the commencement or completion of construction works to minimise crop loss, or to avoid disruption during sporting seasons or other sensitive periods. Access should always be considered if access rights are required over the wider land holding. So this is in the situation where there's no direct access to the way-leave corridor from a public road. Then protections need to be built in, allowing the landowner to specify or approve the access route in advance, and with any particular conditions that need to be attached to it. So, for example, the use of ground protection mats or the formation and removal of temporary tracks or similar. And then finally, for me, in relation to the consideration and compensation package that landowners can expect to receive, the starting point will usually be the payments that a landowner can expect to receive if the rights are acquired compulsorily. However, it is usually the case that higher payments can be secured through negotiation to avoid the additional time and costs involved for the electricity company if it has to proceed under its compulsory powers. That's me for my section, and I will now hand over to Gary.
Thanks, Scott. Good afternoon. I am Gary Webster, a partner in the Rural Business and Natural Capital team at Brodie's, and I'll be speaking today about natural capital. I'll be looking at how the natural capital sector is operating in Scotland at the moment, opportunities for landowners in this sector, and current challenges and barriers to participation. The term natural capital is quite wide-ranging and is often used interchangeably to mean different concepts in the supply chain. But what I would like to focus on is the monetising of natural capital activity in Scotland, particularly from a landowner perspective. Currently, that means carbon sequestration, and specifically under the Woodland Carbon Code and the Peatland Code. These codes are the quality assurance standards for woodland creation and peatland restoration in the UK. Under the Woodland Code, the party carrying out the project must evidence that they have sequestered carbon dioxide from the atmosphere, and under the Peatland Code, that they have reduced the amount of carbon dioxide that would otherwise have been generated by peatland degradation. A carbon unit will be issued in respect of every tonne of CO2, and those units can ultimately be reported by corporates as part of their UK carbon reporting and net zero efforts. There is huge market interest in natural capital from corporates with net zero obligations and fund managers looking to satisfy the increasing appetite within the investor community for natural capital assets and environmentally responsible investment. Although an expected surge in participation in the market by investment funds, which seemed to be gearing up in the spring of last year, hasn't quite happened yet. As many of you will be aware, the codes contain rules designated to ensure that the carbon sequestration can be robustly evidenced, and also that the units are not generated from activity that would have been happening anyway, what is known as the additionality test. So at the moment, activity is all under the Woodland Carbon Code and the Peatland Code. However, there are other carbon sequestration codes in various stages of development, as well as codes that will help promote other nature benefits, including biodiversity. These include the Soil Carbon Code, Seagrass Code, and the Biodiversity Enhancement add-on to the Peatland Code. We expect all of these and others to be brought forward over the next few years. So looking at the existing codes, a landowner that participates in a relevant scheme has a range of options, and the decision on which structure to adopt will be influenced by multiple factors, including their financial position and attitude to risk. If a landowner is in a position to do so and considers that the value of carbon units will continue to rise over time, then it may elect to just retain the full benefit of any units that come from the scheme they enter into. There will usually be grant funding available to cover some of the upfront capital costs, and with a good project manager and the right site, a landowner could see their project develop into a very valuable asset. Retaining units is also useful if any are required as part of their own carbon reporting or supplier agreements. If the land is ever sold in the future, then it can be sold with the benefit of future carbon income, which should enhance land value. A hybrid option might involve a forward purchase agreement or offtake agreement. There's a spectrum of possible structures within this general set, but at its most basic, this is a contract that obliges the landowner to sell an agreed number of verified units to a particular buyer at each vintage of the scheme. Unit prices can be agreed at the outset, perhaps with some form of price indexation, price variation based on vintages, or an agreement that the units will be acquired at market value. These verified units are protected by a buffer, so the landowner generally has no ongoing liability to buyers if there's a loss event after the units have been verified and sold. The benefit to investors is that it provides them with a reliable source of carbon units, while the landowner can rely on the income. It would also be common for such an arrangement to involve some early seed money to help the landowner with establishment costs. As with the first option, if it's structured in a particular way, then land value can be enhanced and landowner risk can be minimized. At the other end of the spectrum, there is the option where a single investor acquires all of the pending issuance units, or PIUs, in a project at the outset. They can expect to pay a significant sum upfront to cover all of the costs that are not grant funded, and an additional premium for the landowner. Common features of such contracts are standard securities to protect the investment and stringent obligations on the landowner to ensure the project delivers the anticipated levels of carbon sequestration. This will result in the project carrying significant liabilities, but with limited future income opportunity for the landowner, and potentially restricting land value and marketability for future sales, and also potentially passing on liabilities down the generations. Risks can be mitigated and the returns may justify this approach, but as with all carbon sale contracts, it's important that entrants go into any arrangements with eyes wide open and having taken sound professional advice. Whatever structure is adopted, this sector continues to grow and rural land is essential to its success and delivery of the projects, so the role of landowners and managers cannot be underestimated. All those who are involved in the sector will know the delivery of projects is not really keeping pace with government targets, and it's recognised that increasing scale is going to be essential to not only the perceived success of the codes, but also to investor and landowner confidence. I would now like to look at some of the obstacles that the sector is facing and how these obstacles may be overcome. Landowners who wish to participate in the sector will not be able to avoid risk altogether. Even if they are able to avoid liability to investors by retaining the interest in the project until the carbon is sequestered, no nature project is certain to succeed in the way that parties initially envisage. Experienced project managers are essential, but even with the best possible implementation, climate and environmental factors, supply chain and labour issues can all impact on the success of the project or sequestration timescales. The cost of all the administrative and compliance requirements of the codes also need to be covered, with no guarantees as to level of financial return, although a bit more on carbon pricing a bit later on. The availability of affordable insurance tailored to natural capital markets would be a huge help in efforts to scale the sector. For a woodland project, for example, insurance may cover fire and storm damage, but standard policies will not cover the cost of lost carbon income from a loss event. Insurance proceeds may cover the cost of re-establishment of the woodland, but such an event will have a material impact on timing for verification of units and the value of those units. There is a lot of insurer interest in the market, looking at both purchaser and landowner interest, but it's specialised and will inevitably be expensive. If there is a structure that can provide insurer confidence and more standardised, affordable products, then that could help unlock the potential. Another barrier to participation can be the uncertainty of how the purchase and sale of units can be regulated and the respective parties protected. We are one of 3 Scottish legal firms who worked with Scottish Forestry to develop a standard form purchase and sale contract with funding from the Ferns Initiative. Peer-reviewed contracts that have the support of the code administrators and come with detailed explanatory guidance should provide assurance and support participation in the project. Whilst there is never going to be a one-size-fits-all solution for carbon projects, we are confident that this process will help inform and educate all parties and hopefully facilitate increased participation. The template contracts and associated guidance notes should be available through the Scottish Forestry website by the end of this month. We also see an inherent disconnect between investor expectations and the realities of delivering projects that are very dependent on landowner-specific factors. Investors and fund managers are very reliant on consistency of approach and documentation and familiarity with the markets they invest in. And this sector is just not quite there yet. As I mentioned above, the volume of projects coming through is not as high as it might have been, and so market trends and the future direction of carbon trading and pricing is not as certain as investors would like it to be. A recent government proposal whereby scheme participants will be offered a guaranteed minimum price for units may also assist in bolstering market confidence and reducing some of the perceived risks. Proposals are at an early stage, but the suggestion is that the landowner will be free to sell units elsewhere if they can get a higher price, but can fall back on the minimum price contract if they're unable to secure other buyers. The cost of establishment, administration and compliance is also a potential barrier and is preventing participation by certain landowners who are otherwise enthusiastic and have suitable land available, but are faced with the prospect of upfront capital expenditure, professional fees and admin costs that are out of kilter with the potential return. We are aware of various initiatives where clusters of landowners are looking to team up in order to share costs in putting a project together that can make a viable return. But these sort of joint venture structures are not without complexity in themselves. In peatland projects, we are yet to see the levels of private investment that would be required to unlock difficult sites and meet the targets set by government. Most projects proceed on a basis of a mix of grant funding and funding from the landowner themselves. That acts as a significant barrier for many landowners who would otherwise hold suitable sites. Hopefully, some of the things I'm discussing here today will assist in bringing private investment into the peatland restoration sector. I am aware anecdotally that there is interest in the banking sector in whether they can provide a suitable product that helps bridge the gap between the cost of a project and the capital grant funding available. We are also seeing efforts being made to address the challenges that crofting creates to the implementation of carbon sequestration projects. And we should probably include agricultural tenancies here as an area where effective structures and solutions need to be developed to ensure that everyone with an interest in rural land is able to share in the benefits. There are some ongoing Ferns projects that seek to unlock the difficulties that crofting and agricultural tenancies present in this market, and it's hoped that pilots from those schemes that are underway will show others how it can work. Our involvement in some of these projects shows us that whilst there is significant cost in agreeing legal documents to allow projects to proceed on croftland and common grazings, the legal mechanisms do exist to permit it. Another perhaps equally significant barrier in this sector is achieving sufficient interest, dialogue and collaboration between the various parties with an interest in the land to agree a way of sharing the risks and rewards on a project where the level of income that can be generated is less certain than in areas such as renewable energy. None of this is intended to suggest that any of the challenges facing the sector are insurmountable, nor that landowners should not proceed with natural capital projects. There is a huge political will to see this succeed and a lot of work and time being invested on the landowner and investor side to develop contract structures and funding models that balance interests of landowners and investors. It is an ongoing process, and we see the next couple of years as key to the future direction and success of the existing codes, as well as natural capital in general. And that's me for this afternoon. I'll be happy to answer any questions through the Q&A function at the end. And with that, I'll hand over to my colleague, Sarah Lilly.
Thank you very much, Gary. Hi, everybody, and thanks for coming to the seminar today. I, like Gary, am a partner at Brodie's and I operate from our Highlands and Islands office based in Inverness. In the agricultural world, family farms represent not only a source of income, but also a cherished legacy passed down through generations. The complexities of managing these assets can become even more intricate when marriage, separation, and cohabitation is involved. Hence, an understanding of prenuptial, postnuptial, and cohabitation agreements is crucial for the farming community of Scotland. These instruments provide a framework for protecting the interests of all parties involved and preserving the integrity and sustainability of a farm. I'm going to address you in two separate parts, one relating to marriage and the other to cohabitation. And the reason for this is that the legal schemes surrounding both are vastly different. So in relation to marriage, if we could have the next slide, please. In order to understand the importance of prenuptial and postnuptial agreements, it's appropriate first for me to give you a brief overview as to how Scots law deals with matrimonial property on separation when no such agreement exists. The Family Law Scotland Act 1985 sets out the principles to be applied when dealing with financial provision on divorce. The emphasis of the Act is on a clean break, with the aim to return each party to financial independence as soon as possible. Matrimonial property is all property belonging to the parties, jointly or separately, which was accumulated during the marriage and which still exists as at the date of separation. Now, there is a specific exemption in the legislation where the property is acquired by one person via a gift or inheritance from a third party. Providing that gift or inheritance stays in the same form or in substantially the same form, the property falls out with the scope of matrimonial property. However, if the funds from the gift or inheritance are used to buy a different form of property during the marriage, that property is converted into matrimonial property and falls subject to the rules of division, which I'm going to set out. The starting point for a financial division in any case of matrimonial breakdown is to consider the principle of fair sharing of matrimonial property. To establish this, we ascertain from our clients what matrimonial property existed as at the date of separation and the value of that property. And when I talk about property, I'm including assets and liabilities. Once we have those valuations and evidence of them, we can then begin the process of advising how the property should be divided fairly, which usually means equally. Having said all of that, as a family lawyer, there are certain distinctive issues that I am aware of in relation to the breakdown of marriage within the farming family. This is particularly the case where farms and crofts are involved, as they often vary from other assets in relation to the sometimes complex ownerships and business structures that exist around them. Crofts and farms can either be owned or tenanted. It is not unusual for the owner or the tenant of a croft or farm to be different to the person or entity that actually farms the holding. The farming business often operates on multiple holdings, and the ownership or tenancy structure across those holdings can vary and may have been acquired at different times in different ways. When negotiating the division of property on separation where farming or crofting interests are involved, it's essential to build a full picture of the ownership or tenancy position, the timings of acquisition, and the visibility of the business structure, including sight of any partnership agreement or shareholders agreement, and the farming business accounts. It will almost always be necessary to have a farm or croft valued by a specialist surveyor and the business valued by a specialist accountant. Another common issue in farming families is when a farm has been inherited. Now, Mark is going to say more about this shortly, but from a family law perspective, commonly farms and crofts, either owned or tenanted, and farming businesses are passed down through generations. And if this is the case, whether or not a party to the marriage inherits a croft or farm before or during the marriage, it is not matrimonial property. However, there are two issues to consider in these circumstances. One is that which I have already mentioned, being the ability to knowingly or inadvertently convert the inherited asset into matrimonial property. The other is that the value of that inherited agricultural asset can be taken into account when considering the respective resources of the spouses and deciding how the matrimonial property is to be divided. If we can have the next slide, please. So why have a prenuptial agreement? Well, a prenuptial agreement, commonly known as a prenup, is a legally binding contract entered into by a couple before marriage. It outlines the distribution of assets, financial responsibilities, and provision for property division in the event of a separation or divorce. The parties to the prenup can be as creative as they wish in relation to what is provided for in that agreement. In an ideal situation, both parties will obtain independent legal advice during the drafting process, with the draft passing between solicitors until both are content with the terms of it. Only then is the agreement signed. However, it is often the case in my experience only one party will take legal advice and have the prenuptial agreement prepared, with the other party not taking legal advice but signing it anyway. Now, in Scotland, properly prepared and signed prenuptial agreements are valid. They are binding documents that will be upheld if challenged in court. The refusal by one party to take legal advice does weaken the strength of the agreement, but that point has not yet been tested before the Scottish courts. Over the course of my 17-year career as a family law solicitor, I have drafted a number of prenuptial agreements on behalf of clients. However, it's undoubtedly the case that I've seen an increase in their popularity over recent years. Despite this, they are still relatively rare, and the absence of them can unfortunately result in lengthy and often very costly negotiations or even litigation in relation to how the matrimonial property should be divided fairly. For the farming community, prenuptial agreements can play an essential role in safeguarding the farm from being divided or sold during a potential divorce. Farming families can often span multiple generations and involve substantial inherited assets. The proper drafting of a prenuptial agreement can ensure that the farm remains within the family and continues to operate without disruption. So a postnuptial agreement, or postnup, is very similar to a prenuptial agreement, but is entered into after the marriage has taken place. It serves as a tool to address changes in circumstances and provide clarity on financial arrangements and asset division in exactly the same way as a prenuptial agreement does. I have had experience of people approaching me in very close proximity to the wedding, looking for a prenuptial agreement to be drafted, and it's not been possible to do so. Instead, they've entered into a postnuptial agreement shortly after the marriage has taken place. The other circumstance which can trigger the need for a postnuptial agreement is when a person acquires new assets or inheritances during the marriage. In the case of a farming partnership, the entering into, at that stage, of a postnuptial agreement can provide a clear plan for asset distribution, ensuring the farm remains operational and within the family in the event of a future separation. In the case of both prenuptial and postnuptial agreements, it's often helpful to keep these agreements under review as the years pass. There can be unexpected changes in the financial circumstances of one or both party, which have not been adequately provided for in the agreement and which can then be addressed in the event of a change. As family lawyers, it's fair to say that we are often very anxious about drafting pre- and postnuptial agreements, as to a large extent, we are trying to predict the future and prepare for any eventuality. However, that is not always possible, so the review by the couple of the agreement every now and again is sensible. So I'm now going to talk about cohabitation. And I really enjoy a statistic when it comes to looking at relationship trends. And the most recent Scottish statistics came about as a consequence of the 2022 census, which provided the following data. Since 2011, there has been a 25.2% rise in cohabiting couples. Since 2001, there has been an 80% rise in cohabiting couples. Between 2001 and 2022, the percentage of households with couples which were married has decreased from 86% to 76.6%. And I've set out on the slide there a table which shows the trends of marriages in Scotland over the past 50 years, and you can quite clearly see a decrease since 1973 to where we are now. It's therefore clearly the case that the cohabiting couple is on the rise and the married couple is on the decrease. However, it is estimated that about 5.3% of cohabiting couples separate in the UK each year, compared with only 1.3% of married couples. So as family lawyers, we therefore need to be alive to this and consider the legal implications for the end of cohabiting relationships. Prior to the Family Law Scotland Act of 2006, cohabiting couples in Scotland had no rights in relation to property post-separation. However, the provisions of the 2006 Act differ significantly to the financial provision on the end of a cohabitation in comparison to the financial situation on the end of a marriage. Cohabitants are defined as a couple, either opposite sex or same sex, who live together as if they were husband and wife, and that is the phrase used within the legislation. Essentially, they are couples who live together in a committed relationship. So what happens in the event of a cohabitation ending when there is no cohabitation agreement in existence? Well, the starting point for couples is the opposite of that for married couples. Neither has an automatic right to share in assets of the other built up during the relationship. There is no pot of assets to be divided. Instead, each party simply keeps what they have. However, in certain circumstances, one partner can make a claim against the other. Such a claim can be made if a partner has derived economic advantage from the contributions made by the other, or if a partner has suffered economic disadvantage in the interests of their partner or child. Unlike when a marriage ends, when no time limit exists for the making of a claim post-separation, in the case of a cohabitation ending, the claim has to be made within 12 months from the date of separation. and after that period expires, no claim can be made under any circumstances. Now, despite rights for separating cohabitants having existed in Scotland for 19 years, it is still an area of uncertainty, with the legislation being far less definitive than that relating to marriage. It's for that reason that a cohabitation agreement in some relationships, and particularly in relationships involving significant wealth or businesses on the part of one or both parties, in respect of a cohabitation agreement could arguably be even more important than that of a prenuptial agreement. It will not come as a surprise to anyone for me to tell you that a cohabitation agreement has a similar effect to the prenuptial and postnuptial agreements that I've already spoken about. A couple can make provision in a cohabitation agreement for what is to happen in the event of the relationship ending, and that therefore removes the uncertainties presented by the 2006 Act. So in conclusion, for the farming community of Scotland, prenuptial, postnuptial and cohabitation agreements are a vital insurance policy and tool for protecting agricultural assets and ensuring the continuity of family farms. In short, they provide a mechanism by which couples can take control of the outcome of a future separation by contracting out of the legislative provisions. By addressing potential issues proactively, these agreements can provide peace of mind and create a stable foundation for both personal and professional aspects of life on the farm. Seeking legal advice and ensuring fair, transparent agreements can help preserve the legacy of family farms for future generations. And with that, I shall pass on to my colleague, Mark Stewart. Thank you.
Thanks very much, Sarah. Welcome everybody to what we might call the Benjamin Franklin slot. He who said there is nothing certain except death and taxes. I am not Benjamin Franklin. I am Mark Stewart, a partner at Brodie's, and I head up here our personal and family team. I've been a private client lawyer now for 30 years. I have lived with the Inheritance Tax Act 1984 throughout that time. Over that time, there have been many changes. Some of those changes have been for the better, and some for the worse. And those changes either through legislation or a pretty steady stream of case law telling us what the words mean on the ground. But I think it is fair to say that there's nothing that I've seen to the extent of what we saw and have seen since 30th October, Budget Day. It represents a fundamental change to the way inheritance tax will work for those with business and agricultural interests. It is a seismic change. So perhaps we should just remind ourselves about inheritance tax and how it works. If we're going to change that slide, thank you. So basically, inheritance tax is a tax on the transfer of wealth, typically the transfer of wealth from one person to another. And the two obvious occasions when that occurs is the transfer of wealth on death, as assets pass from the deceased to his or her heirs, or indeed the transfer of wealth that can occur during lifetime in the case of lifetime gifts. In practice, inheritance tax very much bites on death and less so in lifetime, but it is still relevant, as we say, on lifetime gifts, especially if the gift is to a trust or if the person making the gift has not survived the usual 7-year period. It's also worth remembering that inheritance tax is at a headline rate of 40% tax, and it's a 40% tax of market value. So when it bites hard. That said, it is riddled with various bans, reliefs, and exemptions. It is sometimes called a voluntary tax. I think that is fairly optimistic. It is not voluntary at all, but with good planning, if you play your cards right, it is quite possible to mitigate the exposure to inheritance tax or indeed eliminate it altogether. And within those reliefs, the value of agricultural property relief and business property relief, when it applies at 100%, cannot be overstated. It's an incredibly generous relief. So if you have a £5 million farm that qualifies for 100% APR and BPR, then for inheritance tax purposes, that farm has a value of nil. So the £5 million of value for inheritance tax has a value of nil. And it's unlimited at present. So if that's a £50 million farm or a £50 million trading business, again, qualifying for APR and BPR at 100%, its value for inheritance tax purposes is nil. So you can see immediately how important, how valuable 100% relief is, and currently unlimited in value. But then we have the budget, which takes effect for these purposes with effect from 5th April 2026. If we can have the next slide, please. So what is changing? Effectively, what is changing is the unlimited nature of agricultural property relief and business property relief. So in the future, after 6th April 2026, it is being capped 100% relief at £1 million of value, and thereafter only 50% relief will apply. So another way of saying that is effectively that if you have APR, BPR qualifying property at 100%, the first £1 million of that should have a tax rate of 0%, it's completely relieved, but the surplus value over and above the £1 million is going to be taxed at 20%, half of the full headline rate of inheritance tax. So what does that mean in practice? If you have a £1 million farm, perhaps it means nothing in practice. The APR, BPR at £1 million will cover it. So the inheritance tax exposure may still be nil. In my experience, there are not very many £1 million farms. By contrast, if you have a £5 million farm, that nil current exposure might now look like an exposure to £800,000 of inheritance tax. The £10 million farm or estate that qualifies for relief, if it does, might now be facing a £1.8 million inheritance tax charge, rather than currently, if qualifying for 100% relief, there is no exposure, and so on. If payable, as a result of these new restrictions, the new capping of 100%, if inheritance tax is payable, it will be payable by 10 annual instalments, and those will be on an interest-free basis. So a little silver lining, but that's all it is. The bill will still be paid, must still be paid. And does the £10 million farm have £180,000 of income or capital resources each year for 10 years following a chargeable event? Probably not. And the reality is sale of part of the farm or borrowings are likely to be incurred in practice. So a couple of practical points on valuations next. To remind ourselves, inheritance tax is a tax that works on market value, and that is to say, what is the value that would be achieved between a willing seller and a willing buyer? There are often references to, inverted commas, probate values or confirmation values, in some thought that they're less than market value. That's a misnomer. It's market value. There's no such thing as a different, lower probate value. Now, in the world of assets qualifying for agricultural property relief or business property relief at 100%, we've not really had to worry too much about valuations, because clearly, if it's going to be reduced by 100%, the value for inheritance tax purposes is nil. So quite often in practice, we might see valuations being done on a, what does the value in the balance sheet on the account say, or what is the executive's estimate of the value? But I think practically, we now need to realise that there will be much more attention paid to valuations for inheritance tax purposes of these assets. Clearly, it's relevant to establishing to what extent the assets are covered by the £1 million allowance at 100%. And of course, now tax is at stake, whereas previously it wasn't. If you had 100% relief, tax now being at stake at 20%. So expect more attention from HMRC and indeed the district valuer when we come to valuing assets in these circumstances. So what can be done is the question that many people have been asking themselves, or indeed asking myself. I think the most important thing is to just take a step back for a moment about the changes and remind yourselves, well, what is the succession objective? And sometimes the only way you can get there is to pretend there's a world where inheritance tax doesn't exist. in that world, what would you want to happen in terms of who is to receive the assets? What assets does that comprise? When are they to receive them, and how? Are there any conditions or trust provisions to include on how they are to be received? The objective is still the most important piece of this. So what is it? Let's be clear about that, because then it's the job of the professional advisors to take those objectives in the family circumstances and try and achieve them as best as they can against all the obstacles that lie in the way. And these inheritance tax changes are a great big new obstacle. So some immediate observations for married couples or civil partners is to remind ourselves that you each have, both parties to the marriage, both civil partners, have a £1 million 100% APR BPR allowance. So it follows, try where appropriate to ensure that each of the couple have assets, APR BPR assets that can use that allowance. So if, for example, there are two parties to a marriage, one has no interest in the farm, for example, and the other has the entire interest. In the event of the death of the first to die, if that's the person that doesn't have any APR BPR assets, there will be no allowance being used. You will have lost the chance to use a £1 million allowance. So use it or lose it. And also ensure, and this is something to do immediately, also ensure that there are wills in place that ensure that on the first death, you can capture the first £1 million allowance. It's the same point, use it or lose it. Make sure the will doesn't simply pass everything outright to the surviving spouse, because if it does, you will not be using the first to die's £1 million allowance. And don't panic, first death, we do still have unlimited spouse exemption. So our window of planning here is not the death, not the lifetime of the first to die, but it's the lifetime of the couple. It's important to keep that in context in our planning. What then about lifetime giving? The idea here is that you're giving assets away during lifetime, so that by definition, in the event of your death, you no longer have those assets, so they're not there when inheritance tax bites in the event of death. So if those gifts are outright, which is to say a gift from the individual who owns the asset to another individual, typically an adult child, for example, who's involved in the business, involved in the farm, that outright gift is a potentially exempt transfer and still unlimited in value, whether it's the £5 million farm or the £50 million business. Unlimited potential exempt transfers still exist. Now, of course, there's a consequence if the person making the gift dies in the 7 years, and where that death occurs in the 7-year period after 6th April 2026, we're on the new rules, and business property relief, agricultural property relief will not be available at 100%. So there will be inheritance tax consequences in that 7-year period. Where outright giving is not appropriate, either because of the age of the intended heir or other circumstances, there is the scope to make the lifetime gift to a trust. The different inheritance tax analysis there. A gift into a trust is at the outset chargeable, but that is subject to any available nil rate bands, so allowing value to pass through into the trust at 0%. And still today, agricultural property relief and business property relief applies at 100% if you make that gift into trust before 5th April 2026. So there is scope still to use lifetime giving into trust. But careful consideration, as always, with lifetime giving. If that giving is outright to individuals, you're fixing in on the succession plan. An advantage of retaining assets is that you can change your mind, and you can change your mind for all kinds of reasons. Once you've given the asset, you've fixed that plan. You have nailed the colours to the mast. And there may, of course, be asset protection concerns or asset protection concerns that develop in the future if you've given the asset away outright. And that very much in line with what Sarah was explaining in terms of the family law aspects. Often a concern of clients is, yes, I want to make a gift to the next generation. I trust my son, I trust my daughter, but query their spouse. So there is a point in all of that. And as Sarah was explaining, there are ways of managing that risk. Also, affordability. Can you afford to give away the assets? Do you still need access to the income they can provide, or indeed to the capital? But reminding ourselves, in this lifetime giving plan, you do have the scope to retain £1 million of APR, BPR assets to use against your own allowance. Capital gains tax is also a relevant consideration here. A lifetime gift, an outright gift, is a disposal for capital gains tax. Many of the assets that we're talking about here have very large, significant inbuilt gains, and we're triggering that on a gift. But equally, in many cases, a holdover relief is available, allowing the gift to go through to the next generation, if that's what it is, and the gain is passed on without triggering it, so no tax to pay, but that gain deferred in the hands of the recipient, and if they, of course, sell in the future, the gain is taxed at that point in time. Holdover relief does require a bit of careful consideration. It doesn't apply in all circumstances, so important that if we're going ahead with lifetime giving, to make sure that we've got a handle on the capital gains tax position. And not forgetting that if we're making a lifetime gift, then we have to take into account what is the inheritance tax analysis if death were to occur in the 7-year risk window. And that's, as I say, with the rules changing, if that death occurs in the 7-year risk window after 5th April 2026, we're on the new rules. And life assurance may be relevant to that. It is, of course, possible to insure life over that 7-year risk window with a view to passing the risk of death in the 7-year period to a life assurance company for the payment of a premium, of course. And as well, life assurance may be appropriate as a short or medium term cover, perhaps where there's a thought, yes, we will make lifetime gifts, but we're not ready to do that. That's maybe in 10 or 15 years' time. So do we think about life assurance as a possible solution to cover the risk that would arise if death were to occur, or in a married couple scenario, death of both spouses were to occur while ownership was still retained and in the 7 years after that? The trust consultation has recently been published, so we're not yet in a position where we've got the draft legislation to work out exactly what is being proposed. But the trust consultation is HMRC reaching out to explain how they envisage all of this applying where APR and BPR is relevant to trusts, which may be relevant on the transfer of assets into trust, during the lifetime of the trust, where there may be 10-year charges and exit charges, and then at the end of a trust, quite often there's an exit charge there too. So the consultation walks us through various aspects of all of that and how the revenue are proposing that will be the new rules will apply, and in that we glean some other points about what the changes are looking like. So we've learned a fair bit about the direction of travel. So thinking about those with existing trusts, some good news. Sorry, I've not given you very much good news here, but some good news is that each of those existing trusts set up before the budget, if they had assets qualifying for APR and business property relief in them, then they will be entitled to a £1 million allowance per trust. So I know some clients have got multiple trusts or 1 or 2 trusts all set up with some of those assets in it. So the good news is that they each have this allowance, which will become relevant and helpful on future 10-year charges and exit charges. Those existing trusts, though, do need to take a bit of a policy decision, because unless the value of those trusts is under £1 million, they are going to face 10-year charges in the future, whereas previously, because of 100% APR, BPR, yes, they had 10-year charges, but the value that was being subjected to tax was nil because of 100% relief. So that relief is now being restricted, and we face the prospect of 3% charges at the 10-year point. Subject to the £1 million allowance and any other nil rate ban the trust has available. So there's a bit of an exercise to do for trustees of existing trusts to work out what that looks like in the years ahead, and to work out whether or not the trust should be retained because the costs are considered manageable for all the other protections it provides, or whether actually the trust ought to be wound up. And it appears from the consultation that that exercise, that decision, doesn't need to be made before 6th April 2026, but instead can be made before the 10-year charge that next arises after 5th April 2026. So in theory, that's quite a long window for some trusts, less of a long window for others, just depending on when that 10-year charge arises. And then, of course, there's a thought about new trusts. So is trust planning still something that could be attractive and helpful for inheritance tax, where we're looking at assets that are now subject to these capped reliefs? I think so. I think that there are some things that trusts bring in terms of protection, but also they do allow people to move assets out of their estate where they face here now a 20% effective tax rate into a regime that may have some tax to pay over the lifetime of the trust, but nothing like 20%. So reminding ourselves again that before April 2026, if you have these assets, 100% relief, and it's unlimited in value. So there is definitely a thought about whether new trusts before 6th April 2026 should be put in place and assets transferred to it before that time. And even after that time, actually, when you do the maths, it appears because all individuals will have this £1 million 100% APR BPR allowance. We've all got one. And if we use it during our lifetime by, for example, transferring £1 million of assets into a trust environment, the good news is after 7 years, it will refresh. So you get another go. And actually, the amount that you'll be able to transfer in without any upfront inheritance tax as you transfer assets into the trust is actually £1,650,000, taking into account not only the £1 million allowance that you've got that will refresh every 7 years, but your basic nil rate band as well. So £1.65 million every 7 years. If it's a married couple, the scope for 2 lots of that, £3.3 million. We can see quite quickly how quite a lot of value can be taken out of the 20% exposure into a trust regime that will involve 10-year charges, but not at that kind of level of exposure. So what should you be doing now? As I said, we don't yet have the legislation, but we've got a fairly clear idea of what is coming. So I think the first thing to do is to work out what the changes mean to you based on the asset profile that you have, based on your objectives and your family circumstances. So trying to work out to what extent do the changes suggest there's going to be a problem. And then, of course, either taking action now or taking action when exactly what we've got in front of us is clearer. I would recommend to you all to line up your advisors sooner rather than later. The demand for legal, tax, accountancy, valuation advice, for quality advice will rise over the course of the year. Google tells me there are 377 days before the 6th of April 2026. So there is some time, but those days will disappear quite quickly. So I think the phrase is lawyer up, have your advisors in place and start thinking about what needs to be done. And then finally, there is a question about should we just weather the storm? This budget is, of course, a budget of a Labour government. I don't think it's a political comment to say we will not have a Labour government forever. And might a future administration revert to unlimited 100% relief? Certainly that was the move in the early 1990s. Before that time, relief here was at 30% and 50%, not 100%. And it was introduced back in the early 1990s to bring up the reliefs to 50% and 100%. So that might be something. I don't know the answer to that. I do remind myself sometimes of the old adage of plan for the worst, hope for the best, and prepare to be surprised. Thank you.
So thank you very much, Mark, Sarah, and Gary for all those excellent presentations, and Scott as well. I don't know if you can pop your cameras back on and we'll go into the Q&A session. Great, okay, I think everyone is there. So good, well, look, thank you very much. We've got a few questions here, if you just bear with me. So going back to natural capital, Gary, there's a question, I think it's a question, it's asking about, are landowners protected by the buffer after carbon units are sold in the event of a loss event?
Thanks, yeah. The quick answer is Yes, provided we're talking about verified carbon units. So the buffer is designed to protect parties against a loss event that affects verified carbon units. Um, and that is assuming that the various scheme documents in setting up the scheme were complied with the risk assessments that needed to be in there, and the appropriate loss reporting procedures are followed in the event of the loss. It's important to note, though, that it doesn't cover the sale of PIUs, pending issuance units. So, the potential for carbon sequestration in a scheme. So, if you sell your PIUs up front on a scheme, then those sales are not protected by the buffer, and nor does it protect unverified sequestered carbon for a verification process. So if the carbon is in the trees but it hasn't gone through a verification process, a particular vintage, then that would not be covered either. So essentially, before verification, they're not protected, but after verification, they generally are protected by the buffer.
Thank you very much, Gary. Hopefully that answered it. Now, so I've got a question here for Sarah about prenup and postnup, I guess, and cohabitation agreements. And obviously, Mark touched on the importance of that really now, more so because inheritance tax changes are encouraging people to push assets down into the hands of the younger generation. And so we're getting these multi-generational farm businesses and also younger people with less established relationships who may be holding considerable assets. Sorry, my camera's just popped off. So the question really is, are these agreements 100% watertight?
The simple answer to that, Clive, is that yes, they are, if they're properly drafted and entered into, and both parties are of sound mind when they sign them. These agreements that have to be voluntarily entered into by both parties to the agreement. So if one is reluctant, then no pressure can be applied to the reluctant party. The question hasn't actually been addressed in the Scottish courts, but there's absolute clarity in the minds of us as family lawyers that, as with any other minative agreement, even those entered into post separation, when there hasn't been a prenup, postnup, or cohab agreement, as long as they're properly drafted, ideally both parties obtain independent legal advice, and both parties are of sound mind, and there's no reason why they should be set aside.
Good. Thank you very much. So I guess you would see this as a part of the package of business sort of succession planning. You've got your partnership agreement, perhaps you've got your prenups, your cohabitation agreements, your will, succession plan. It's all part of one kind of package, which is not just looking after the individuals, but also looking after the business for everyone in it.
Indeed, yeah.
Jumping back then to utilities, Scott. I can't actually see on my screen, but I think you're there. There's a lot of surveys going on at the moment because we've got these various new pylon routes planned and the new alignment routes have been published and so on, and that's moving on into surveys. So the question is, can power companies insist on taking access to my land for carrying out surveys?
So that falls into Schedule 4 powers under the Electricity Act, so the other statutory powers that I mentioned. In most cases, an agreement will be reached with the affected landowner occupier, allowing entry for surveys and similar purposes on a consensual basis, but the power companies do have resort to use statutory powers to insist on entry if required. So there is a process to go through, as you would expect, that requires it's a 14-day notice period having to be given to the affected owner and occupier. And in the case where surveys are being carried out for intrusive works, then details of those works have to be included with the notification as well. So that would typically have, the location of where the works are being carried out and how long those works are going to take. Probably just worth mentioning other statutory powers under Schedule 4 include rights to lop trees that might pose a safety risk to electricity pylons and lines, or anything that would interfere with access being taken to and from the lines for inspection and maintenance purposes. So again, there is a notice period that goes with that, and if the owner doesn't take steps to lop or remove trees that pose a danger, then the power companies have rights to come on and do that.
So I guess it's a good argument then, Scott, for landowners to be getting advice on this, whether it's from land agents or lawyers and so on. And a concern that we often hear is about the cost. How do people manage that?
Certainly, the exercise of any of the statutory powers under Schedule 4, so if it actually goes through a statutory procedure following service of notices, there are clear compensation provisions under that part of the Act that provide for compensation for loss or damage arising as a result of the exercise of those rights. That is claimable as compensation. Again, it's where it's just allowed on a consensual basis. Normally, that would be agreed with the land agent or with solicitors, if solicitors involved, that yes, no, entry is being permitted, but it is subject to making good damage and compensating for any loss or damage that can't be made good.
Okay, good. Thanks very much. So I think we've got time for one last question. Gary, this one's for you. Going back to natural capital, maybe a good one to finish on. Someone saying that the uncertainty makes them reluctant or unsure as to how to progress. Should they just sit and wait, or should they start to do something, and what might they do at this stage?
Yeah, I mean, there's no one answer that fits everybody, because it all depends on personal circumstances. But I suppose my own thoughts on it are, I don't see the natural capital market disappearing. As we get closer to net zero targets, government net zero targets, I think the interest from corporate entities in ways of offsetting their carbon footprint are going to increase. And I do think at this stage that interest and demand in the carbon markets will increase as we get closer to those targets. So providing you're in a position to progress a scheme, my feeling on it is that you should certainly be looking into it. At the moment, there is capital funding available for most of the schemes under the woodland and peatland codes. And I guess that capital funding can't be guaranteed for all time coming. So if you're in a position to progress a scheme, even if that means, or particularly if that means then just retaining the units as and when they're verified, I think at this stage we deem that as an accruing asset. The value is there if you keep a hold of the units. So if you're in a position to do it, it's difficult to see where the downsides might be, in the sense that if you withhold the units, there's an asset which is going up in value. So yeah, I think it's worth exploring, and I certainly wouldn't advise anyone to rule it out because of the uncertainty of where the market is presently. I don't think it's going anywhere, so I think going forward, it's a worthwhile asset to have if you're in a position to do it.
Great. So lots of potential in the future, lots of value in there for Mark to deal with, and for Sarah to try and keep in the right place, and no doubt Scott will be trying to keep the utilities out of it. So on that note, I think we're going to bring this webinar to a close. I'd like to thank all of our speakers, Scott, Gary, Sarah, and Mark, for their excellent presentations, which I hope you found useful. I should mention as well that we will be sending out copies of these slides to everyone who has signed up for this event. And if anyone would like to get in touch with us, please contact any one of us on the screen, and we'll be happy to help you. So thank you very much. Thank you for attending, and enjoy the rest of your afternoon.